how do I get into real estate when I can't get a loan? And as I'm digging in and trying to figure out real estate, I discover commercial real estate around the same time that I discover self-storage. And I went to a conference called the Best Ever Conference in the spring of 2017, saw a man by the name of Scott Myers talking about self-storage up on stage, and literally went to lunch after that and sat down on a lunch buffet table that I say changed the course of my life.
Welcome to the Real Freedom Show, where we inspire you to pursue your passion to gain time and financial freedom through opportunities in real estate. I'm your host, Mike Swenson. Let's get some real freedom together. Hello, everybody. Welcome to another episode of Real Freedom, Real Estate Leverage Freedom, where we talk about different ways that people are building time and financial freedom through opportunities in real estate. I'm your host, Mike Swenson. If you want to get started on your real estate investing journey, check out our website, freedomthroughrealestate.com. It's where we post all of our episodes, great articles, information, whether you're outside of real estate looking to get in or inside of real estate, trying to figure out where you want to go, what path is next. We know it's fail forward and try a lot of different things to figure out what you want to do. And so we're happy to help support you in that. Super excited about today. We've got an awesome guest, Neil Henderson. Neil is a professional real estate investor, co-host of the Truly Passive Income podcast and general partner of Nomad Capital. And for you guys focus on self-storage based out of Wilmington, North Carolina, somewhere in the range of $75 million in commercial real estate transactions, raised capital in the realm of $17 million in investor equity, and acquired over 311,000 net rentable square feet of self-storage facilities. Excited to hear about what you do and where you go. For those folks that have tuned in for a while, you can go back to episode 202, where we had Clint Harris, who is Neil's business partner. And so got a chance to hear his story and share. So Neil, we're excited to have you on to be able to share your story. So welcome to the show.
Happy to be here, Mike. Thanks for having me.
Just start with us, kind of for you. Let's take us back, kind of why real estate, and talk about how you got started on things.
I was a failed accidental landlord in Las Vegas, Nevada. I bought my first piece of real estate in 2005, a 3-bedroom, 2-bath condo in Las Vegas. It was a year-old condo that had doubled in value in a year. Should have been my first warning, but I bought it there to live there, and watched the value of that property go from, I think, $205,000 up to $275 at one point. And then in the great financial recession, watched it drop down to about $60,000 when I did a short sale on it. During that period, I got married, was looking for we were planning to have kids. We ended up buying a house in Las Vegas in 2013 and had a little guest house at the front of that house. And for about 30 seconds, it was going to be my ultimate man cave, until my wife was like, absolutely not. That's going to be where our family and friends come to stay. So we built out that little guest house like a little hotel room. We added a coffee bar, a small mini fridge, a microwave, just a comfortable place for our family and friends to come and stay. No plans beyond that. On Christmas Day of 2013, my mom came to me and she handed me this article about this company called Airbnb. And she said, I think this would be a great thing for you guys to do with your guest house at the front of the house. And I was like, yeah, whatever, Mom. And, but I went away and thought about it that January. And I was like, well, what would be the harm? It's just sitting empty most of the time. So I'll give it a try. So went out, took some photos of it, posted it on Airbnb. And within 48 hours, we had our first booking. And we were 65% occupied from that date until March of 2020, when COVID shut us down. And we were one of the highest rated listings in Las Vegas during that period. And that was sort of my intro into real estate, like really real estate. It was kind of mailbox money. I was like, man, this is really good. How do I figure out how to leverage this? How do I do this? How do I do more of this? Well, Las Vegas was by that time, very quickly became hostile to short-term rentals. So I couldn't really figure out how to scale short-term rentals there in Las Vegas. So I started looking, researching, into other real estate, fell into the bigger pockets black hole and started learning about different real estate asset classes and things like that. And then eventually found self-storage. And I can go into that story if you want, but I'll stop there and let you ask any questions.
Yeah, I think so interesting to hear that a condo purchase for you is what started it all on the way down. Same for us. 2006, we bought a townhouse. We're super excited that we bought it for $2,000 less than the previous owners bought it for 2 years prior. And then we watched it tank to half the value of we bought it for. So I get it. And what's interesting there, some of those learning lessons is it forces you to figure things out. I talk about holding real estate, you're figuring out problem solving. How do you learn how to problem solve? By solving problems. Problems have to come up for you to learn how to solve them. And so that's part of what real estate is too. Like it's cool to find a property. Maybe oftentimes you hit the nail on the head and you get a good property or asset, whatever asset class you're in real estate. However, things happen and you've got to learn how to think on your feet and adjust. And so, yeah, for you guys too, then having your purchase, flipping it into an Airbnb. I remember the first time we have some short-term rentals too. First time I hit to go live on Airbnb, I was like, how long is this going to take? And pretty quickly, we got a booking for like 2 days later. So it's cool how fast that can happen too. And I think that also speaks to things can happen more quickly, things can happen more slowly. And then two, you got to dip your toe in different parts of the water inside of real estate to figure out what you like and what you're good with. So talk a little bit about the self-storage for you, for people that might be considering different asset classes. Talk about what was it for self-storage for you that was attractive?
Well, before I get into that, I want to touch on something you just said there, which is problem solving. Because what happened for me in 2014, I ended up having to short sell that condo. I was a defense contractor. I had been renting it out for about 2 years, and I had it was negative cash flow, like $500 a month. And I had my tenant was military, was on a 2-year lease, but they got PCS, so they were able to break the lease and move out. And all of a sudden, my $1,500 or my $500 negative cash flow turned into about $1,800 a month in negative cash flow. And my wife had recently lost her job because she was pregnant with our son. And suddenly we had this, major financial crisis facing us, and we had to short sell it. Didn't want to do that. It's not quite a foreclosure, but it shows up on your credit report like a foreclosure. So, but we got it. It was a smart move. Didn't like doing it, but it was a smart move. Had to do it. But suddenly that put me into a position of I'm just now discovering real estate and getting excited about real estate, but now I can't get a loan.
Yeah.
And so I had to figure out, all right, how do I get into real estate when I can't get a loan? And as I'm digging in and trying to figure out real estate, I discover commercial real estate around the same time that I discover self-storage. And I went to a conference called the Best Ever Conference in the spring of 2017, saw a man by the name of Scott Myers talking about self-storage up on stage, and literally went to lunch after that and sat down on a lunch buffet table that I say changed the course of my life. And I met my partner, one of my partners now, Eric Hemingway. And he was sitting there and telling this story about how he had built a self-storage facility from the ground up in 2006, and then gotten on a sailboat in the Mediterranean and sailed around the Mediterranean for 3.5 years with his family. And I was like, I need to get to know this guy. Now, it was a lot more complicated than that, not nearly as smooth sailing, pun intended.
Unintended. Yeah.
Yeah, but that was where we made a connection. I started trying to figure out how I could help him. I had been raising a little bit of capital for multifamily syndications at that point. I knew enough to be dangerous on the multimedia side and started my own podcast with my wife, and started learning about real estate investing by actually interviewing people who were experts in real estate investing. And that was sort of how I got exposed to self-storage, the commercial asset class. And Eric and I I started trying to figure out ways that I could add value to Eric's business. And Eric was a small operator at the time. He only had one facility. He eventually built his, right around the time I met him, he built his first conversion. He bought another conversion. And then shortly before I moved here, he bought another facility that he was looking to expand, but he hadn't done any syndication. And I was constantly telling Eric, "Hey man, you got to syndicate." And he's like, "Nope, I'm not ready." And he was smart because he was proving his business model before he started taking on investor capital. But he also recognized that he didn't want to be on that side of the business because commercial real estate, especially syndication, is a team sport. You're going to have, it's not usually just being a one man operation. You're going to have somebody who specializes in acquisitions, underwriting, capital raising, operations. I mean, it's not usually just going to be one person doing all of that. And so I just looked for a way for me to add value and just kept at it until eventually an opportunity arose for me as the Nomad Capital team was coming together. It was a chance for me to come here and be a part of that. And I'm grateful for that opportunity coming to me, and I'm grateful every day for the move that I made.
How long was that from kind of first meeting at the conference to joining up on the team?
A long time. It was February of 2020 before we were at the conference again. I'd come to visit him several times. We stayed in touch all the time. I was trying to make it on my own in Las Vegas with self-storage and just beating my head up against the wall. He was looking for ways to like scale his business and was always kind of running into this problem of, he had deals, but he didn't have money. And we sat down at a bar in Colorado at this best ever conference with him and his son, Levi, who's the man who co-founded the Nomad Capital with. And I said, very drunkenly at the time, I said, "Hey, I want to help you guys get to $100 million in assets under management." And I meant it. And they said, "All right, let's go." And we left that conference just fired up, ready to go. We were going to take on the world. And then we went back in that March of 2020, COVID hit. And it just absolutely blew up my world, blew up their world. And that delayed us about a year. But I sold my house in Las Vegas in June of 2020 because the unemployment rate in Las Vegas was 25% at the time. I had huge amounts of equity in that home because that Airbnb was allowing me to basically pay down my mortgage faster. So we almost owned that house free and clear. It had gone up in value a huge amount. My dad died the same day that COVID became a thing. My mom was a widow, and we moved in with my mom and formed our own little COVID pod and sat back trying to figure out, oh, what's our next move? And I finally, in late 2020, made the decision that I was going to move to Wilmington and talked to my partner, Clint, whose wife is a real estate agent. I said, "Hey, I want to buy a small multifamily property in Carolina Beach, North Carolina, and we're going to house hack it." And he said, "Yeah, get in line." But I eventually went to a mortgage broker and said, "Hey, tell me what I can afford," and went to him and said, "Hey, let's do this." And so that was the first step. Bought a house across the street from the beach in Carolina Beach and told Eric and Levi that, "Hey, I'm serious. I'm coming there. We're going to make this happen." And finally moved in October of 2020, arrived here on October 24th of 2021. We syndicated our first deal that fall, and we were off to the races.
So many things that I want to chat about there real quickly, because this isn't something that, often gets talked about, is kind of the networking piece. So, we go to conferences, we meet people. A lot of times we don't follow up with people. You collect the business cards or the digital business cards, and you don't follow up and stay in touch. So for you had mentioned, really trying to find ways to add value to Eric and then keeping in touch over time. How much of that was, I would say, actively intentional on your part, how much it was maybe just mutual connection and relationship, like, oh, we really bonded or it really worked well. Because I'd love to hear that, because so many people meet these people at conferences, and obviously sometimes things work out, things don't work out. So I was just kind of curious to hear how much of it is like, yeah, we just stayed in touch because we enjoyed each other's company and did that, or how much of it is like my next business decision, my 5-year plan is add value to Eric, like that's like obviously super intentional. So kind of how would you see that, maybe that relationship going from we meet at a conference to now I'm on his team? Obviously you had to take some big steps and you moved to North Carolina, which is huge as well. But just curious to hear kind of how that first meeting turns into business partnership.
It was much more a mutual bond. I'd have to say I was very intentional about trying to add value without the expectation of getting anything back from it. And I think that's really what you need to go into things with is, and then just have a little bit of faith that if it's something that's going to be mutual beneficial, that things will work out. I did not come into this relationship with Eric going, all right, I'm just going to add value, and then he's going to eventually bring me on at all. I was very much, and I told them multiple times throughout a relationship, I don't know what this is going to look like. I just love being around you, and I love what you're doing, and I enjoy the value that I'm bringing to the relationship. And then just hope it's going to work out, and not really go in with an expectation that it is. And that's hard, because I was giving a lot of my time, but he was also giving a lot of his time back. I mean, I would come to visit him. We would have calls where he would be giving me advice on storage deals that I was looking at, with no expectation that he was going to get anything out of it. And that's sort of where I think you need to approach it, is that how do I add value without any expectation that I'm going to get anything back from it? The whole idea is to give without expecting anything back. But with the faith that if you do that honestly and with good intentions, that eventually it will come back to you.
And I think part of it too, and maybe I'm wrong here, is, he was on the early side of his journey too. So it's kind of like you're similar paths, similar spots, trying to figure things out. It's not like he was, hey, I've got this $100 million portfolio. Who's this guy, Neil? What can he add value for me? You were growing separately forward and then decided to come together too.
Correct. And that really, he was not, he was a bit of a close carrot for me. He wasn't so far ahead of me. I didn't go up to a guy who had $3.5 billion in multifamily assets under management and say, hey, let me partner with you.
Yeah.
He was a guy who, at the time, he owned one self-storage facility. Once I met him, he built his second, and then a third and a fourth. And I just stayed in touch with him, not expecting anything out of that relationship other than he was just a really cool guy. I mean, anybody who's been around the Hemingways for any period of time comes away kind of changed, and a bit of, we talk about it, sort of like drinking the Hemingway Kool-Aid. Because they're just good. They're good people. The whole family is great. I'm not blowing smoke, and I'm not saying that to, like, I don't know, I would say overly complimentary, but that's just who they are. They're just
Hmm.
good people. Life's too short to spend time with jerks. And I always tend to just gravitate towards those people who are just good people.
So touch on the self-storage piece. You'd had some Airbnbs. You talked about the challenge of trying to scale that. You talked about commercial loan versus, having the ding on your credit and personal loans. So what was it, kind of about self-storage as you looked at where you're going to spend your time that was attractive and interesting to you?
Well, the first eye-opening moment was just the whole idea of commercial real estate, is that it's a very mathematical formula. I mean, it's not, you look at residential real estate and it's very squishy. The value of the property is very much based on the comps in the area. Like, if you have a $200,000 house and you improve it by $50,000, you put $50,000 into it. It's not necessarily it's not going to, like, increase the value by $100,000. That's not guaranteed. Whereas with commercial real estate, there's a very concrete formula. It's the net operating income divided by the cap rate, pretty much. And you can see that if you're able to either increase the revenue or decrease the expenses to increase the NOI, and you've got a cap rate that is either coming down, that's going to increase the cash flow on the property, and two, increase the value of the property. So that was the first eye-opening moment. It was just the whole idea of commercial real estate is that it's a lot. I can understand the value and the formula that an asset is based off of. It's a very repeatable formula. And then the second thing with self-storage was it's such a simple business model. I mean, you're essentially you're renting a box of air to people. There's no toilets, there's no trash. There's tenants, but it's month to month. Whereas, you get into multifamily, and there's nothing wrong with multifamily. People need a roof over their head, but it's much more complicated. You've got plumbing.
I agree. I'm in it.
Yeah.
Yep.
I mean, no offense to it. I love it. I'm an investor in multifamily. Self-storage, it's got a lower expense ratio. With multifamily, you're typically looking at about a 50% expense ratio, not including the debt service, whereas self-storage is anywhere from 35 to 40%. And what we've seen is that the longer you own a self-storage asset, that expense ratio actually comes down. Eric's facility in Arizona that he built in 2006, the expense ratio is like 20%. So that means 80 cents of every dollar that comes through that door comes to him, not including the debt service. So it was I just got it. Self-storage it was a simple business model, in a commercial real estate that I could see the way you can push the value, you can force the appreciation, in simple ways. So that was really what drew me to it. And it's also it's an asset that I see has demographic tailwinds behind it, just like multifamily does, just like assisted living, things like that. And that's really kind of where that's the pond I want to play in.
I fully get it. I naturally migrated from being a residential agent to working with investors in small multifamily to then scaling up to apartments. And there's a piece of me that looks over and is like, that sounds pretty cool. And yet I have the experience in what I've done. And so I totally understand that. I was going to quick mention too, when you talked about commercial lending, I still remember my first conversation with a commercial bank when I was looking at getting a loan for some commercial property. All of my background was less than 4 units, and so yeah, we're looking at the credit report, we're looking at the in debt to income ratios and all that. And when the lender was telling me like, yeah, we look at the income of the property and the expenses, and depending on how that plays out, we decide on the loan. And obviously it's, important who you are in terms of who we're investing in, but like your income is less important in those regards. And I remember I said, so you're taking a commonsensical approach to giving a loan on the property. And he said, yes. And it's like, that was a light bulb moment for me because yeah, I realized like I grew up in this, we had a second property as a rental or, whatever over time, the 10 years prior to being in real estate full time. And I was so just wired with debt to income ratios and how do we get that up? And I need to make more income to qualify for more and all that. And then when you see this commercial lending, it's like, oh, that kind of doesn't matter as long as the property matters. And you go find good deals and find those down payments and learn how to manage them and run them. The sky's the limit.
Absolutely. It's just there's a great analogy that I heard from another self-storage investor named Ryan Smith from Elevation. I want to give full credit where credit's due. And he talked about taking his kids to a Walmart parking lot. And he said, all right, I want you to go around and I want you to find me $1 in change. And the kid's like, oh, Dad, this is stupid. And so those kids walked around and they found change and eventually came back to their dad with $1 in change. And he said, okay, now let me explain to you how this works in commercial real estate. So you just found an extra dollar. That's now take that and multiply it by 12 months. So that's $12. So now you've increased your income by $12 and divide that by a cap rate of 5, and you've just increased the value by $240. Now take that and multiply that by 500 units, where you've just increased the rent or the revenue on 500 units by $1, and multiply that by 12 months, and then divide that by a cap rate. And you've just increased the cash flow significantly. You've also increased the value of that property significantly, that you can then go to a bank, a commercial lender, and say, hey, I've increased the value on this property by X amount, and they'll lend on that amount. You can do a cash out refinance, which, by the way, you can pull money out of that deal, which comes to you tax free.
Tax free. Mm-hmm.
Which you can then redeploy into another asset, or just take it out and whatever. That's essentially how, this is how rich people live now. They basically, they buy, they borrow, and they die. And that's so much of what commercial real estate is about. And it's one of the things I love about it.
Yeah, I heard a recent interview with Pace Morby, and he was talking about that. Like, he put money into I think a personal residence or vacation residence, and he's like, yeah, the money that we got for that was because we refied this other property, pulled the money out tax free, and that's the money that we used in that property. And so, yeah, as you grow over time and add that value, your income can come from your refis at different times, and it's just another tool in the tool belt, right? And so that's what I love, is there's so many different ways to win in real estate, and there's so many benefits. So
Sorry to interrupt. So many newbie real estate investors are focused on cash flow. I want to get to 10 rental properties that are, making $500 a month in cash flow, and that's going to pay me $5,000 a month, and I'm going to be able to retire. The reality is that cash flow in real estate is what keeps you alive while appreciation does its work. More millionaires in real estate were made by appreciation than were ever made by cash flow. That doesn't mean that you count on appreciation, but it's so often that so many newbie investors get trapped in this sort of cash flow mentality. It's like, I need to buy 10 rental properties, and they're going to each pay me such and such. I'm going to pay off one at a time. Then eventually I'm going to end up with $10,000 a month in cash flow. And I'm going to be making $120,000 a year, and I'll be able to retire and live on a beach. Well, that's not really, that can work. And there are plenty of people who've done that, but the real sauce happens when you start really looking at appreciation and figuring out ways to force appreciation. And that's one of the things I love commercial real estate, is because it's a very repeatable model where you can force the appreciation by literally doing something as simple as lowering the expenses or increasing the revenue.
are you looking to get started or scale in real estate investing but don't know your next step? Are you overwhelmed thinking about finding deals, analyzing deals, doing due diligence, and managing properties on top of it? Go ahead and push the easy button and invest with us. Real estate investing is what we do full time. We've done dozens of deals with hundreds of doors. We have the knowledge and experience to handpick the best deals that most investors can't find. We've got large off-market deals all the time where you can hopefully find returns and economies of scale that you just can't find on your own. The best thing is it's 100% passive to you for less capital than you put down trying to acquire a property on your own. Don't let this year go by where you don't make the leap, add to your portfolio, or you just sit in analysis by paralysis. To find out more, visit freedomthroughrealestate.com and click on invest. You can book a call and learn more there. So get to scaling your portfolio now with us by your side. So talk a little bit about Nomad and what you guys are focusing, obviously self-storage, but talk about the locations, maybe even just the markets and self-storage as a whole. You had talked about, seeing kind of long-term where self-storage is going. I'd love to hear more of your thoughts on just kind of the industry, where it's going and kind of what you guys are focusing on.
Sure. Well, first, let me talk about sort of where the state of the self-storage industry is right now. Self-storage has been a very recession resilient asset class. I've heard some people, some of the self-storage gurus will say it's recession proof. BS. It's recession resilient. It's a trauma and transition business. Typically, you're going to be, 30 to 50% of all storage customers come by people moving. It is people either they're moving because times are hard, or they're moving because times are good. They're moving because they're getting divorced, someone's died, they've got a new job, whatever. Um, and that's why it's been a very resilient asset class, because in good times, people are renovating their houses. They're, moving from a smaller house into a bigger house. They're buying toys that they don't have room to store. And then in bad times, people are, they're moving into smaller places. They don't want to get rid of their stuff. They're moving to a new location because they've got a new job somewhere. But an unusual thing, we're in an unusual environment the last 3 years in self-storage. We were sort of coming into a period of a market reset in self-storage towards the end of 2019. We'd sort of reached this kind of peak supply in storage. There'd been too many storage facilities built, and things were starting to kind of come down. And then all of a sudden, COVID hit, and that was like throwing gasoline on a smoldering fire with storage, because all of a sudden, everybody was moving around. People were turning bedrooms into home offices, homeschool rooms, and suddenly storage had this brief explosion. And it went crazy for a period where occupancies went like this. All these groups that had been sort of pulling back on building new storage all of a sudden started throwing money at storage. Well, then coming out of COVID, the home prices shot through the roof. And at the same time, interest rates rose faster than they have in decades. Some people say it was the fastest time ever. I don't think that's true, but it's one of the fastest rise in interest rates ever. So suddenly, home affordability became a massive issue, and it's still a big issue. And all of a sudden, people stopped moving, and that really, starting in about late 2022, early 2023, it became sort of a bear market for storage. And we saw it, facilities that were already stabilized, that already had, 95% occupancy, their occupancy dropped down below 90%, down into the 85, but not, nothing terrible. But a lot of our facilities were in lease up, and anybody who was in lease up, you have traditionally storage leased up at, a very consistent 3% per month. You could pretty much count on it. If you wanted to lease up a brand new facility, it would typically take you about 28 to 30 months to lease that up to 85 to 90%. Well, all of a sudden, we started seeing facilities that had been leasing up for 3% per month all of a sudden drop down to 1% per month. Now, that doesn't sound like that big of a deal, but that's a 66% drop in lease up velocity. And now you're suddenly talking about a facility that you're expecting to lease up in 30 months is now going to take 60 months or longer. And that created a real problem for a lot of people. I won't say that we didn't get impacted by it. We really struggled to lease up. But what then happened was a lot of groups that had been looking to build new self-storage all of a sudden rapidly pulled back. Became very expensive the debt became very expensive. It became very difficult to underwrite facilities because the rental rates that groups were charging were all over the map. You couldn't underwrite it, so couldn't get lenders. We do self-storage a little different. We do it with a little bit of a twist. We don't buy self-storage. We don't build self-storage. We convert self-storage. We buy existing buildings that are vacant, that have been vacant for years. We can buy them typically for below replacement cost, and then we convert them to climate controlled self-storage. Now that gives us a little bit of an advantage over building self-storage. If you or I, Mike, wanted to build a ground up self-storage facility, it's usually going to take us about $120 to $130 a square foot to build it, and that does not include the price of the land. It's also going to take us on average anywhere from 12 to 24 months just for the land and entitlement to get it permitted, to build the infrastructure there. And then another 12 to 14, 12 to 18 months to build it. The average time to build a ground up self-storage facility right now, this month, is 2 years and 10 months. So almost 3 years. On average, it is our last 8 facilities we bought them and converted them for an average of $65 a square foot. And it takes us on average 12 to 15 months to build them now. So we're building them for almost half the cost of ground up development and in about a third of the time. And that makes a huge difference right now with where interest rates are, because the holding costs are what kill you in new storage development. You're going to get to a point where you build it out and you're open, and now you're trying to lease up, and you have an interest only period that's going to come to an end, and you're going to have interest reserves that come to an end. And suddenly you're having to pay that from the income that property is producing. And that's gotten a lot of operators in trouble.
Yeah, no, that makes a lot of sense. And size-wise, just for the folks listening, how many units and how many square feet are the facilities that you're looking at?
Yeah, we want to be above 50,000 square feet net rentable. Any smaller than that, and you're usually, the juice isn't worth the squeeze. So we're usually targeting buildings that are 75,000 square foot and above, because with a conversion, you're going to lose about 25% to doors and hallways. So, if we buy 100,000 square foot building, that's usually going to net us about 75,000 net rentable square feet of self-storage. And on average, about 750 units. The average unit size is going to be about 100 square feet.
Got it. And then in terms of markets or, locations within a market that you're targeting?
Yeah, we're primarily playing in the Southeast. We're in Virginia, North Carolina, South Carolina, Georgia. We're looking in Tennessee. We love the Florida market, but the Florida insurance market has just got us spooked right now. We're kind of staying away from that. We are typically going to be in secondary and tertiary markets. You're not going to typically see us in a Charlotte, but you are going to maybe see us in a Gastonia. You might not see us in a Raleigh, but you're going to see us in a Kernersville or a Rocky Mount, where it's, those really hot markets that are starting to force people out, where they're, the people are expanding into the exurbs and things like that.
Awesome. Well, Neil, it's been awesome to hear your story, the personal side, kind of why self-storage, and then obviously talking about Nomad. You guys are doing some awesome things. Cool to hear how the market's going as well. And yeah, there's some tough conditions in the market. Obviously, interest rates are huge for anybody in real estate, because it impacts everything that we can do, and what's feasible and what's not feasible. But yeah, excited to see you guys continue to grow, and thanks for your time coming on the show, and best of luck to you guys in the future.
Thanks, Mike. It's been a pleasure.